By the end of June, 51 million people held A shares in their trading accounts, many of them with not much faith in the long-term value investments. Jiang Wei is one of them. As an investor with experience of China's market plunge in 2008, he says he had a premonition of problems before the bubble popped.
When the market started to fall, I thought it was just the IPOs draining liquidity from the market, so I didn't adjust my positions. But then when the market kept falling for 2 or 3 days, I began to sense something was wrong, so I cut my position by 30%. But I had to leave, remaining 70% stuck there. There was nothing for me to do but play dead.
The Shanghai Composite fell more than 30% from its peak on June 12th until it hit bottom on July 8th. Jiang says things start to look better for him after the government's urgent market rescue actions. But one of his friends lost $1 million, 5 times the annual take-home pay of most white-collar workers. There's no denying the losses have hurt, but their impact appears more limited than the numbers themselves might suggest. Tang Jihong, an undergraduate at Columbia University and a technical stock trader, as he calls himself, took a 5% loss during the recent market turmoil, but says people shouldn't blame their losses on the government or the market.
It's really interesting, like when people earn money, they're really excited and talking about it, like how well I trade, like I'm the best trader, but when the market is crashing, they never talk about it. Yeah, even if they talk about it, they talk about the government, they complain about the market, but they never blame themselves, like, yeah.
Wherever the blame has gone, many Chinese investors have been showing a humorous attitude toward their losses and the market plunge. One of the most common jokes has been that after today's losses, this evening you will have to eat noodles in the dark. A suggestion that tonight you will have to save not only on dinner, but on electricity too. Both Jiang and Tang, of course, support of the government's market rescue efforts, not so much for private investors' sake, but to keep market risks from spreading to the rest of the financial system. And they plan to go share buying again whenever they think things have bottomed out. Xiaocen, ICS for CCTV, Shanghai.
What a big story that's been in the past couple of weeks. In response, China's state-run banks have provided around $200 billion to try to stop the stock market sell-off, the kind of government intervention that's drawn quite a bit of criticism from economists from around the world. But the World Bank president has defended Beijing's recent moves.
We have to understand the recent market fluctuations in context. You know, this is a relatively young market. It's only been around for about 20 years. If you look all around the world, governments take measures all the time to reduce excess volatility in their markets. And so this is exactly what China did. The Chinese government is extremely committed to the market-oriented reforms. And so that's really the important thing. The 7% growth rate we think is encouraging. That's about what we think will happen this year. And we feel that if China continues to remain committed to its reform progress, we think that prospects for growth in the medium and long term are good.